Instead of working for money, make money work for you. In this video, I'm going to share with you the key lessons that I learned from reading this book, The Little Book of Common Sense Investing. You know, with the overload of information, it just could be so overwhelming, this whole topic and area of investing. But you know, it's so refreshing to get just an easy and simple, straightforward approach that gets real results over the long haul. In this video, you're gonna learn that easy, straightforward, and passive way that you can get real results in your investment journey. Hi, my name is Yvonne and welcome to my channel. This channel is really all about leveling up and personal growth so that we can all become the best version of ourselves. So if you haven't already, subscribe to join our community. Just a little disclaimer that I wanted to share with you. I'm not a financial advisor, so I'll encourage you to seek professional advice from a financial expert that really will take the time to look at your situation and provide advice. But at the end of the day, I want to reiterate, it's your money. You work really hard for it. So at the end of the day, your decisions with your money is your choice, and also the consequences of your actions. So we'll take responsibility for all of our choices. And with that, let's go ahead and get started. John Bogle is the author of this book, The Little Book of Common Sense Investing, and he founded the very first index fund and founded the Vanguard Group in 1974. And you know, it's interesting, this company is still flourishing today. In fact, it has about $7 billion as of 2020 and assets under management of 8 trillion with a T as of 2022. And so the philosophy and principle of this company is really based on a lot of wisdom and experience, and ultimately it's about conservative investing, and they honor true investing over speculation. So with that amount of experience and wisdom, I would pay attention to what he had to say in this book. We're gonna go over why the key to long-term success here is really investing in index funds that are low cost and track the entire stock market. We're also going to go over index funds and compare that to other financial instruments, such as individual stock picking or mutual funds, also ETFs, exchange traded funds, as well as bonds. So we're gonna take the time and we're gonna compare these at a high level. And we're gonna cover the importance of having healthy investment habits, like having asset allocation, diversification, and rebalancing your portfolio. So let's step back here and talk about the basics. First of all, what is an index fund? Well, an index fund is a collection of multiple stocks and bonds. It's really a basket of different kinds of funds. And the traditional index fund really captures the entire stock market. And what that gives you is less risk and more diversification. So you might ask yourself, well, how do you know how big the slice of the pie gets to be within that total market fund? Well, it's determined by what's called the market capitalization. And the market capitalization is a way of measuring how big of a slice of the pie that the company gets. It's really just pretty much saying, well, how much value do you bring to the market? And that's determined by multiplying the number of outstanding shares that the company has by the stock price. And that magic number gets you the market capitalization. And that shows the value that that company brings. The more value, the bigger the slice of the pie it gets. Now, I know some index funds do focus on specific sectors, but that's not what we're talking about here. For example, the technology sector. But if you remember, the dot-com bust it really affected that particular area. And so many people that put all their eggs in one basket, so to speak, really were affected here. So we're definitely talking about true diversification. And so one good example is the Standard & Poor's 500 index. And certainly there are others, but this is a good one because it represents about 80% of the American market here. And even fund managers to date compare the value and the success or failure of their particular fund. They compare it to the S&P 500, almost like that barometer. And so that goes to show how strong that really is. And so that's what we're talking about here. So I definitely wanted to step back and make sure that we understand that although there are different types of index funds that are specific to the sector, like healthcare, technology, that's not what we're talking about. We're talking about total market index funds such as the S&P 500. Let's talk about understanding the costs of investments. There's a quote that says the greatest enemy of equity investors is expenses and emotions. So let's talk about expenses. A lot of investors get excited about what they're going to invest in and worry about the expenses later. So I don't want this to happen to you. That way you're not surprised at the end of the day on the costs that are eating away at your investments. So the types of costs that you're going to hear about is, for example, management fees, brokers' commissions fees, sales loads, promotional expenses, operating expenses, transaction fees, portfolio turnover costs, and of course, taxes, capital gains taxes specifically. So what am I saying here? I'm saying that right before you invest in a fund, after you've picked your favorite, you're going to want to take a look at the expense ratio. Now that expense ratio really is covering the cost of your investment. And that is taken not from the principal, but from the dividends and from your capital gains. And so really it's chewing away at what otherwise would be in your pocket. So the average range or cost of this expense ratio is about 1% to 1.5%. If you find a fund that is less than 1%, good for you. Good for you. In fact, let's take a look at an example here in the chart that really shows what's called the tyranny of compounding costs. Here, for example, it shows, let's say you've invested just $10,000, okay? And over a span of 50 years, look at that huge gap over the lifetime. You're really losing almost $200,000 that you would have otherwise gotten. What I'm saying here is we really need to pay attention to the expense ratio and ultimately the cost of investing. This brings me to the comparisons of index funds with the other financial instruments. First, let's compare index funds to mutual funds. So right out the gate, I do want to share with you that for mutual funds, you definitely make less because of the high expense ratios, which we just covered. So the higher cost that they're going to charge you at the end is going to eat away at your investment. So pay attention to this because it may sound great. It may sound like a great mutual fund. They always do. But at the end of the day, compare those expense ratios to a total market index fund, okay? And then that really is going to help you have a wiser decision. And, another point on mutual funds is they try to beat the market. And, there was a chart here in the book that really shed some light in terms of how well they do fare as when they try to beat the market. And do they really? Well, the reality is that they don't. In fact, in here in Exhibit 10.1, it shows altogether it's really 87% of the funds among those original 355 that in one way or another failed to distinguish themselves. If you're looking at historically how they have performed as compared to the index fund, not so well. So it's definitely something that you should consider as you make your own decision for your own hard-earned money. Now let's talk about index funds compared to individual stock picking. So for the average person, really it ends up being a lot of time that they need to invest in researching companies. And then also the problem is it's easy to get emotional, and these emotions, greed, and short-sightedness really comes to bear and makes us make hasty decisions instead of wise decisions when it comes to individual stock picking. And so a lot of times it's compared to a casino. In fact, the book illustrates it like a casino in that, the house always wins. And in this case, that's the same thing too. The house, when it comes to the stock market, is, these brokers and the fund managers and advisors, because at the end of the day, they take their cut whether you win or lose. What you want to do is, instead of trying to find the needle in the haystack, just buy the haystack. And that's essentially what index funds is. You're essentially diversifying and reducing the risk by really investing in the total stock market. And so that essentially is buying the haystack. And certainly there will be an opportunity for you to be successful over the long haul that way. But let's say you actually enjoy speculating in the market and you find just some emotional satisfaction, the sense of satisfaction with doing some research and a sense of more control. Well, go for it. In fact, in the book, it's encouraged to set a certain amount aside if you want to. It's known as funny money or your play money. In fact, when you go to Las Vegas and you're going to the casinos, you do that, don't you? You kind of say, okay, this much is what I'm going to gamble with and no more than that, right? So you set your fun money aside so that you can go ahead and, hey, if you hit the jackpot, good for you. So in this case too, we're not saying don't invest in individual stock, but set a certain amount, maybe 5% for instance, and the rest of the 95%, you're more conservative investing, because at the end of the day, this is your hard-earned money and you want to make money work for you. And this essentially, I think, would be you would be better served if you approached it this way. Let's talk about index funds versus exchange traded funds, or ETF. There's really two key differences between an index fund and an ETF, and that is really the psychology of it and the psychology of the price fluctuations. For ETFs, it encourages more of a day trader mentality because the price fluctuates throughout the day. So you can secure the stock at that particular price that day. So you can kind of take a look at the market and time the market so that you're able to secure and lock in the stock price at a price that's most convenient for you. However, with an index fund, that is not the case. The index fund price is set at the end of the day, just like everyone else. So it's not like you are making out like a bandit here and you're getting an edge over anyone. No, in fact, when you invest in an index fund, you really don't know exactly to the penny the cost of that particular stock price, because it will be determined at the end of the day. And so, you're kind of you're not getting that sense of control. And but you do have that hands-off approach, which is favoring for those long-term investors and that passive investor. And that brings me to the second point, which is another key difference is your ability to automatically invest. For ETFs, they do not have it set up so that, at least at this point, to automatically invest into your particular fund. You actually have to actively go in there and select your fund. However, with index funds, you set it and forget it. You can set, let's say you want to invest $100 or $500 or more for the month. Then you just set it and forget it, and it's as good as done, and you know every month you are investing. However, with an ETF, you have to have the discipline and the will, and also have the emotional resilience, if you will, to be able to log in there and invest even during the market fluctuation. So now let's talk about index funds versus bonds. And just stepping back a little bit, so a bond is just basically a loan. So instead of going to a bank, the company or the government would raise their funds by going to investors instead. And in exchange for the bond, the investor gains a set interest. In this case, a total bond market fund would work. Just stay away from actively managed bonds because they're less efficient. You know, in this case, it's important to note that bonds do have lower returns than stocks. But what bonds help you do is to really balance things out and allows you to have less risk. So it's really not a matter of should you have bonds. It's really a matter of how much bonds should you have, okay? And there's a distinction. So essentially what we're saying is absolutely you should have some buffer and less risky investments, and that's where bonds comes in. But the percentage or how much you should invest in depends on your age. Let's talk asset allocation, diversification, and rebalancing for just a moment here. So as I mentioned in the onset, you're going to want to really take a look at your asset allocation as it compares to stocks versus bonds. Stocks are more riskier and bonds are less riskier. So for instance, in this chart, it shows based on your age, just roughly how much our investments could be. And now again, your asset allocation is really an individual decision that you make. You might ask yourself, well, how often do I rebalance it? Well, it's recommended that you take a look at your asset allocation maybe about every 6 months. And if there is a shift of about maybe 5 percentage points or more, then it makes sense for you to take a look and rebalance your portfolio so it really does reflect what you're trying to achieve. The bottom line here is you've got to get financially literate to secure a better financial future. And really, instead of working for money, make money work for you. You know, I've created a money mastery program, and there's 2 parts to the program. The first part is the psychology of money, and we're really going to get into how to improve your relationship with money, how to stop the self-sabotaging behaviors around money, and also eliminate those limiting beliefs that are really wreaking havoc in the wealth and abundance that you can create and that's available for you. The second part of the program is financial literacy, and we're going to go into core personal finance principles and investment strategies to really set you up for success. So click on the link in the description box below to enroll in the program. If you enjoyed this video, remember to click on the like button and subscribe so you're notified in new videos, and I will see you on the next one.